A very good morning and happy Friday to everyone. This is Mohammed Ashik Khan. A continuous discussion on the mock paper, paper 2, questions, continuous discussion. Let's start with those questions. The last question that I stopped was question number 8. Today, let me continue with question number 9. So what is the question number 9 speaks about a car was purchased by a business in May 2011. They have not given you a day. So it is comfortable to assume the car has been purchased on 1st May. The car has been purchased on 1st May. It is comfortable to assume car has been purchased on 1st May 2011. And what they say, the business adopts a date of 31st December as its year end. So the year end of the business are 31st December each year. So if you see 1, 2, 3, 4 years I have highlighted here. The car was traded in for a replacement vehicle in 2014 at an agreed value of 5,000. So it is more or merely a sales. The value of the sales is 5,000. So sales proceeds from disposing the car is 5,000. So that has been agreed. So if you see here, this is what the sales proceeds. Okay, then what they say? Then they say it has been depreciated at 25% per annum on the reducing balance method, charging full year's depreciation in the year of purchase and none in the year of sale. Now there are 2 points here. There are 2 points here. One is about the depreciation policy. They say that in the year of purchase, if you closely watch, the year of purchase is 2011, and they say that they charge full year's depreciation here, regardless of the number of months the vehicle is in business. During that year, they will still charge a complete year's depreciation. So in total of 12 months depreciation we need to charge. But if you really calculate, it will be like May, June, July, August, September, October, November, December. 8 months are there, but however, we have to charge full year's depreciation. So this is year 1. And then year 2, no problem. 2012, there is no issue. Second year, 2013 also no issue. Third year. But then they also say, in the year of disposal, they say that none in the year of sale or year of disposal. So this year, regardless of when you have disposed and how long the car is in presence with the business, we will not charge any depreciation. This is the company policy with regard to the depreciation. Further, the depreciation method, they say that reducing balance method. These 2 methods you need to aware of. And one more thing, they are also testing you on the capitalization policy of what is the right concept of how to recognize the capital expenditures. Now the cost of desert 10,000, obviously it is a capital expenditure. However, road fund license, the road fund license has nothing to do with the car. Now it will not, even if you don't pay this 150, it will not refrain you to purchase the car. It is only a problem to drive the car on the road. When the police will catch you, you may have to pay a fine. However, you can still keep the car in your house. No issues at all. Car is in workable condition. So how you define capital expenditure? Any expenditure incurred in order to bring an asset to its intended location and workable condition. Therefore, this 150 cannot be considered as a capital expenditure. That must be revenue expenditure. Sometimes we use the term capex and opex. This 150 is an opex. So with that understanding, we clearly now understand that the cost of the car is only 10,000. That's why we start our depreciation calculation on this 10,000 and we follow reducing balance method. Accordingly, the year 1 depreciation, there is no issue. What you do is you simply multiply 10,000 times 25%, you get the answer 2,500. Then the second year, how you arrive this 7,500 is easy. 10,000 minus 2,500, you get 7,500 into 25%, which is 1,875. And the third year, yet again, you arrive the net book value for the third year at the beginning of here, this period. So during this period, what I am referring. So here again, so from this 7,500, what you subtract is this 1,875 and then you multiply by 25%, you get 1,406.25. So then what you do is you take the total of all this. This is known as accumulated depreciation. That is known as accumulated depreciation. So then you know the cost of the asset, you know the accumulated depreciation, and accordingly you can arrive the net book value, which is 4,218.75. And this vehicle was able to exchange for an agreed value of 5,000. Therefore, the business is making a profit of 781.25. Ignoring the decimal, your answer to the question here is second option, profit of 781. That's the answer to question number 9. Now, if we go to question number 10. At 1 January 2013, a company had an allowance for receivable of 35,000. What you do here now, you open an account for allowance for receivable. You open an account for allowance for receivable. You have an opening balance 35,000. You have an opening balance of 35,000 and then write off, and then also they say there's a receivable of 620,000. So you have receivable 620. Now what they say, they are giving you two information, a write off as uncollectible, receivables totaling 30,000. From this 620, we need to subtract 30 as recoverable debt. So the remaining answer is 590, and this will be taken to P&L as an expense. 30,000 will appear here. Okay, now what they say, adjust the allowance for receivable to an amount equal to 5% of receivables. So now we need to calculate the closing allowance will be 5% of this. So 5% of 590,000 into 5%, 29,500. We have opened up a T account here. The closing balance is 29,500. So when you balance this, so we have a balancing figure. That balancing figure, I guess it is 5,500. Let me reconfirm though. 35,000 minus 29,500, which is, as I told you, 5,500. And this is P&L. It's a credit in the P&L. So here what you do is this should be subtracted here, 5,500. If you do that, your answer will be 24,500. So the net P&L expense. Let me see what they have here. So 24,500 is the final answer. So that is question number 10. Now let's work out the question number 11. Annual sales of a company are 235,000, including sales tax at 17.5. So when they say including, see, this is the total sales value including sales tax. Now to give you an understanding, if your sales value is 100 and the tax as per the given rates 17.5, so the sales with tax will be 117.5. So this 235,000 stays at this level. Now, what the question here they are asking you, half of the sales are on credit, regardless whether it's a credit sales or cash sales, your sales tax will be 17.5% of the net amount. The gross amount is 235, so we have to work out the net amount. Anyway, the receivables in the statement of financial positions are 23,500. That information necessarily not relevant. We don't need to worry about that. Well, only simply what you have to do is that you just have to do this calculation here. But this calculation, see, this is the gross value, and this is what I have arrived here, and then I need this, so that is this. So accordingly my answer will be 35,000. So if you see, you have to write down there 35,000. Next question. Beta purchased some plant and equipment on 1 July 2011 for 40,000. The scrap value of the plant in 10 years time is estimated to be 4,000. Beta policy is to charge depreciation on a straight line basis. So with a proportionate charge in the year of acquisition. What is the depreciation charge on the plant? Beta's financial statement for the year ended 30 September 2011. Now if you see closely, see here, the year end is 30 September 2011. The year of acquisition or the date of acquisition is 1 July 2011. 1 July 2011. And how long between these two? July, August, September. So there are 3 months. And the cost of the asset is, cost of the plant how much? 40,000. And the scrap value 4,000. Accordingly, the what you call this depreciable amount, which is 36,000. Now they follow a straight line method, 10 years time, so 36,000 into 1 over 10, you get 3,600. However, since we charge proportionate basis of the actual time period with the asset is in use, we have to calculate the number of months here. As we did, that is only 3 months. So therefore 3,600 into 3 over 12. This is 1 over 4. Therefore answer is 900. So let me see. You have an answer? Yes, you have an answer there. With that, I sign off today's recording and await for my continuous other questions on this series. It will be beneficial for all the students who are studying ACCA and even any other accounting literatures. Thank you so much. Keep tuned on to my YouTube channel. Do subscribe and share, and don't forget to press the bell button. Have a nice weekend.